Today on Change and Triumph, I'm joined by Colette Dixon, a leading voice at the intersection of commercial real estate, education, leadership, and community impact. So Colette's career includes strategic real estate transactions totaling more than $2 billion with a B, and she currently serves as executive director at the Marshall Bennett Institute of Real Estate at Roosevelt University, where she is helping develop the next generation of socially conscious real estate leaders. So, welcome.
Hey, how are you today? Good to see you.
Yes, we met by basically, I was referred to you, someone that I met at IMN, and
Mhm.
this is a conference amongst multifamily real estate investors. And he said, you need to call, it was funny, it was the end of the conference, and he goes, you need to call her, Colette Dixon. Call her right away.
That was nice.
Yeah, which was wonderful. And I was so grateful for the contact and just to learn exactly what's going on in multifamily. But before we
Mhm.
get into everything that you are about, I'd like to know a little bit about, like the audience to know a little bit about you and your background. You told me you went to college thinking you'd become a corporate lawyer.
Yeah.
And, it just, that's not exactly, you didn't know a single lawyer, but it seemed like a good idea. Can you
Well,
speak a little bit about it?
kids come up with ideas all over the place, like where they want to be when they grow up, right? You're doctor, lawyer, Indian chief, whatever that is. But I don't know where it came from. I just thought being a lawyer sounded like a good idea and went down that path thinking that was going to work. But I did get a business degree. Back to the corporate lawyer thing. You need to understand business if you're going to be a lawyer in that space, I thought. But when it was time to go to law school, wasn't really feeling it and felt I needed to get a job. So fortunately, that business degree came in handy and I wound up leading me to a role as an analyst with the Prudential Insurance Company of America, which,
Nice.
unbeknownst to me, was an investor in real estate and offered me this opportunity to join their team in Atlanta. And I'm like, well, Atlanta sounds like fun. Real estate, don't know anything about that. But hey, I'm not planning on being here very long. Um, got there, had a world of business open to me that I never knew existed, and really kind of fell in love with the product type, with the concept, with the sector, and spent my entire private sector career in the real estate space. So it's kind of an unexpected twist. And never went back to law school, but I did go to business school. So
Wow. And so, what did that Midwestern kid carry into this industry that no one expected? I know you got the business
mm.
degree, but what would you
I, d-
say
you
no one
know,
ever expected?
what people didn't expect, I think. Honestly, I've been around a long time. So, back in the day when I got in the space, there were very few women. There were even fewer women of color. I'm from a Midwestern city. I grew up in Cleveland, went to school in Northern Indiana, started my career in the South in Atlanta. Couldn't have picked a better place to start. But, as you can kind of figure, there's a little bit of a culture swing in there. So there were people in Atlanta who were a little stunned by this Midwestern girl who was pretty outspoken and a little self-confident. It was an interesting dynamic, to say the least. But I learned a lot about myself in that space. And I think that being one of the earlier women of color in that space was an experience for the industry and an experience for me. We had to kind of get comfortable with each other. It took a while, but I think I did pretty well. I think it worked out overall. It was okay. Had
It
its moments though. It did have its moments that were like really questionable, but it was all okay overall.
And let's talk about one of those moments. I mean, you actually lived through the great financial crisis and
Yes.
watch colleagues that you say were good people leave the industry. How did that make you feel at the time? And
Well,
why don't you go ahead and tell us circa what year are we talking about?
so the great financial crisis, yeah, I think it started showing itself in 2007, really hit the wall in 2008, 9. And we started feeling like we were coming out in 2010. So at this point, that was like more than 15 years ago. It's kind of an amazing thing, isn't it? It doesn't seem like it was that long ago.
It
But I'd
doesn't.
say The GFC was probably the third market correction that I'd gone through in my career, but it was definitely one of the more dramatic. And it shook up the industry in really unexpected ways. I mean, the commercial space, I've always been in the commercial space, just to be clear. I've never spent any time in like the single family space.
Hmm.
I think those of us in the commercial space initially thought it wasn't going to be something that affected us, right? This was all about houses. It was all about overbuilding of houses or fraudulent mortgages in houses or whatever the heck that was. But
Right.
it wound up hitting everybody, right? And companies had to kind of revisit how long was this going to last? And I think some of us thought we might never recover from that, right? It's just the numbers were so bad. And I had a lot of colleagues choose to leave the space at that point. I mean, some of us had been in it for a while, and it was like, maybe this is a good time to go try do something different, or it's time to step away. The industry was shaken in a way that a lot of things changed, a lot of platforms changed, a lot of strategies changed, and companies started thinking about how to do more with less, and they weren't going to have these big teams anymore. And we're still seeing that in many respects in the industry. That adjustment kind of stuck. So people were having a tough time finding a space. But for those of us who were able to hang in there and to find a way to still create value or preserve value, maybe it was preserving value at that point, and hang in there were some great upsides. People saw some great returns coming out of 2010 to like 2021. So that wasn't a bad cycle if you could make it through the GFC.
Right. Now, I'm curious, how did it affect the commercial real estate industry? Because at that time I was in residential. I was in residential mortgage, I
Uh-huh.
had single families, and that. So I felt that side of the industry. What would you,
Uh-huh.
I'd love to hear how exactly it affected the multifamily side.
Well, I look at commercial as being multifamily office, retail, industrial. It's that whole other universe of the real estate side, and including also, debt, collateralized debt, CMBS debt. So there was no debt out there. So capital was extremely constrained. So there wasn't much you could do with things. There were so many challenges around occupancies, valuations. There was a time at which we were looking at the share price for Prudential. Prudential had gone public in like 2000, maybe 1999. And
Mm.
there was a time at which our share price was so low that the company was almost valued at less than its biggest fund. I mean, that didn't make a lot of sense. There are these sort of like non sequitur moments of like, wait a minute, we're not in CMBS, or we're equity investors. We have solid
Right.
investments. What's the problem here? And everything was shaken in the economy.
Mm.
Every piece of it was shaken. So it was a surprising series of concerns. And it's like, will the market respond? Will retail ever come back? Will people be able to afford to buy homes, or will people have jobs? You remember there was huge job loss
Right.
across the economy.
Right.
There wasn't any debt. Banks were struggling. It was just a huge, huge nightmare, right? So it's like, how do you recover from that? So it hit everything. It hit virtually everything. But,
Yeah.
we tested the banks. We got them back online. Families that had cashed out of their real estate before the GFC, many
Mhm.
of those family offices that owned real estate had pockets of cash. They then saw opportunities to buy things at reduced pricing when the market came back. And that
Mhm.
really helped swing the market back into vibrancy, especially once the banks stabilized. So it hit everything. There was nothing that was unscathed during that like 2-year period. It was crazy.
I know it was crazy. And I very specifically remember after everything kind of crashed out in 2009, I actually moved back from New York to the Midwest.
Yeah.
And I was in a little small town in Wisconsin called Two Rivers, Wisconsin. Bought a two-family house over there. And I saw all of this opportunity, and I'm looking towards the next opportunity, which at the time I was looking at the research that starting in 2011, there would be 33,000 seniors retiring a day. So I
Oh,
was looking at okay, I'm going to buy up all of this property and do senior living in these single family homes, which were all up for sale. I
Okay.
submitted a proposal to my local bank, which I was doing pretty decent business with. And he goes, "You're in real estate? I didn't know you were in real estate," and closed 4 accounts. Just shut
Oh,
me
well, just shut you
down. I was
down.
like,
That's right. That's rude.
no, you are absolutely right. There was everyone was shaking and there was no money at all, and you
No,
survived that. Now,
survived it.
what made you want to stay in the space when so many people were, seemingly getting out of it?
I think that where I was placed at that time, I was still with Prudential. It was a different company than the one I had started with many, many decades before that, it seems. Prudential had gone from being just an insurance company to being a global investment financial services firm. And that evolution gave us a lot of strength. It was hard, but it still gave us some strength. And we
Mhm.
were able to kind of withstand that. Like I said, this was like the third market reset I had been through in my career.
Right.
And every market reset, if you are fortunate enough to have that sort of resilience, if you've got the capital base that you can hold on to, even though it seems like it's going to fall apart, but you can hold on to it, you then see the opportunity. There is always opportunity coming out of a downturn, especially in the real estate space, right? So it's all about picking the right time. It's all about the patience. It's about, you know, identifying the capital so you're ready to do that. It made sense to me to say. I mean, I was just in a great spot with a firm that was able to rebuild pretty quickly and rebound into the market. So it gave me a chance to move from the new investment side back to the disposition side and help with the restructuring of our portfolios and capturing capital gains when the markets returned. So I was busy. I mean, and that's one thing in this industry. If you're not busy, then you're definitely at risk. But I was always busy, and there seemed to be enough of a demand for what we were trying to do. And it was a good time for us to be, staying in the market, and it was a good time for me. So might have been
It's so
ideal
funny.
to do something different, but at the time, it seemed like a pretty safe space to be.
That is phenomenal. And you're saying something that I don't think you even realize you're saying, but is not common knowledge. That Prudential is an insurance company, not a real estate company.
Prudential is a financial services company,
It's
which
a
is even
okay,
more,
financial
yeah,
services,
services
financial
company. Yeah,
services. So it's a
yeah,
financial services company and it
yeah,
it's an institutional investor that invests in commercial real estate to
yes.
serve its investors. And, a lot of people don't know about that. Could you just kind of
Yeah.
expound?
Well, as I said, we started as an insurance company. I think a lot of people have been around a long time, are familiar with The Rock and that it was an insurance company. It made the decision um, a long time ago that it wanted to manage money on behalf of other people, right? Its investors. Sometimes it was money that was managing its own money. Well, let's go manage money for other people. We can do that. We've got the skill set. We've done it for ourselves. We've proven that we know what we're doing. And around the time that it started making that transition, the real estate industry became more of an investment industry. It wasn't one of those, we're just a lender. Because actually, a lot of insurance companies have always been lenders in the real estate space. It was a way to use their premiums and to get a return on them, right? So they were lenders. Well, Prudential, along with many of its peers, saw that there was opportunity to be an equity investor. It could be more than just a lender. You could participate in the upside. You could create more value if you were an equity investor. Additionally, the real estate industry started going through its transition. The REIT markets came back in the 80s. The expansion of real estate investment trusts as a tool for investing in real estate really became the thing in the 80s and 90s. And financial services on a broader scale was a great pathway for insurance companies to expand their ability to make money. Prudential just bought into that wholesale and said, well, then not only can we do it for other people, we can create a whole new business model that can be used to help provide financial services, resources, investment strategies for a whole range of people. And the real estate side became known as Prudential Real Estate Investors. And it was a, investment management platform focused on real estate investing on behalf of pension funds, other type of, large institutionalized investors, and continued to grow, became a global platform. And I would imagine now probably the portfolio is in the tens of billions of dollars, which was a huge growth. And fortunately for me, I got a chance to be there as that transition happened, which gave me a career path in this industry that I never could have imagined. I mean, who knew that was going to happen? I had no idea. And remember, I was only supposed to be there a couple of years.
Well,
So
sometimes
being
you're just in
there,
the right
it worked
place at
out.
the right time.
Sometimes that just works out that way. Yeah. Yeah.
It does. And you were there at the right time, even through the bust and working through that, which gave you so much insight into cycles of real estate.
Oh,
And
yeah.
like you said, you've lived through 3 cycles. But you told me also that values don't always go up. And it sounds like that's a weird thing. I mean, because people think that real estate always goes up.
Mm,
And
mm.
I think over 8 to 10 years it does. But what's the lesson you learned the hard way that you now feel obligated to pass down?
Well, I think what many people currently in the industry who've only seen mostly up cycles, what you said, they believe that values always go up. What we tend to have lost in some of this incredible expansion of real estate as an investment strategy, I mean, as a real, dynamic, large economic sector, is that real estate is an illiquid asset except if you're going to buy shares in a REIT, okay, which makes it a stock, right? Real estate as a true property type is an illiquid asset. It is not something that is meant to be owned and flipped. It is not meant to be a quick turnaround type of investment strategy. Occasionally, you luck out and you find that unique opportunity that you are there in the right time and space. But for the most part, this is not something that is meant to make people rich quickly. It's a long-term investment. And with that illiquidity, you've got to be prepared for cycles. You've got to recognize that values shift, that you have to have the sort of capital foundation to, withstand those shifts because they don't always go your way. So I try to make sure that when I talk to like our students, about being a part of the real estate industry. And this even holds for single family, I believe. Real estate as a whole is not a quick get rich quick model in reality. It can happen that way, but that is the anomaly. It is a longer term investment. It is not a get rich quick scheme. It is not a stock. So you have to just have that sort of patience and perspective so that you're prepared for the ups and the downs.
Warren Buffett would agree with you even that stocks are not quick flips either. You buy
That's
it, you own
true.
the
You have to
company.
think it yep, you gotta figure out what's gonna happen. Those things change
That's
so
right.
quickly.
And wealth, it's funny because a lot of us don't realize that there's such a big difference between being rich and being wealthy. And
Yeah,
wealthy do, look at the longer term investment. You
mhm,
gave me this image when we were talking about AI behind the wave, on the wave, and ahead of the wave. And said
yeah,
the bottom line is everybody has to prepare for it or it's going to run you over. And I'm sure
yes.
having been through a few cycles in real estate and technology,
Mm, yeah.
what do you think AI is going to expose about people, companies, or industries that aren't ready?
It's this whole AI thing is it's probably talked about more than what's going on with real estate values right now, right? We are more focused on how AI is gonna impact jobs, how it's gonna impact decision making, how it's gonna run the world, or how it's gonna basically, ruin everybody's personal privacy. I'm not really sure. It's everywhere, right? It's everywhere and it's involved in everything. But I think that there is a need for us to look at what's really the best value proposition for using AI. I mean, is AI really meant to make our decisions? And I don't think it is. I think AI is meant to help us make better decisions. AI can help us make better decisions faster. AI can bring data into a conversation that you might not have had. But we can't default to say that AI is always right. because AI is picking up data from all over the place, right? It's scraping the internet, it's scraping, public information from all sorts of places, even places it probably shouldn't be. But yet, it should not be the tool that makes the decision. And we should not default to what it's saying is always right. Because actually, many times it's incomplete. Sometimes it's downright wrong. And then we've had situations where, as they call it, hallucinating. It's basically imagining things that don't even exist. We've had lawyers with briefs quoting cases that don't exist. We've had, analysts using numbers from reports that are incomplete. It's it's a great tool. Like many tools, you can use it well or it can use you. And so as I'm trying to get myself comfortable with AI, and there is so much there. I was actually on a call yesterday with a colleague who had gone through this whole exercise around which AI platforms are being used in the commercial real estate space to do certain things. Market research, reporting documentation, financial analysis, operating analyses, all these things that you can use it for. And yet you still need to go behind whatever it tells you to be sure that it's a real source, to be sure that it's actually analyzing things the right way. And for people who don't recognize that, I think that's highly risky. And I think that some firms are assuming that AI can replace humans faster than AI is really able to replace humans. I mean, I guess there was actually an interesting article. Was it like, did you hear about the story like maybe a week or so ago that it might have been an automotive maker who had a huge staffing reduction because they thought AI was going to replace all of these functions and realized they're not ready to do that.
Oh, wow. No, I
You know,
didn't hear about
and
it.
so, you have to companies made some really big bets, earlier this year as AI was just jumping off the world. And I think they're starting to realize that you still need humans to check things. You still need the human to review, analyze, and make the decision. It can't make the decision for you. It shouldn't make the decision for you. And so I'm hopeful that people recognize that they still can have value and how they can continue to be a valuable part of whatever process it is. And companies can respect the fact that the human intelligence is still a very valuable piece of the consideration here. But yet we all need to understand it. We all need to not be afraid of it. And we need to be curious about it and constantly try to see where it's going and see how we can use it better. And then how we can continue to make ourselves valuable in the midst.
You're so right. And how's the university? When it first saw ChatGPT, you told me the initial reaction was fear. And so how is it actually working in schools now from what
I
you
think
can
we're still figuring it out. I think we're still trying to figure it out. Yeah, I think we've realized that we can no longer say, like, no. Although, was it Harvard Law that basically said there'll be no phones in classes? I mean, we do know that given an easy way to get an answer, a student will pursue it. Whether or not it's the best answer, not always the case. We want our students to continue to learn so that when they get something from AI, they're able to discern if that makes sense or not. If you don't understand the underlying concepts, you can't evaluate whether or not the tool is actually helping you. So on the university side, at least on the real estate side, we're all trying to figure out how to integrate useful AI into coursework, how we can help our students feel comfortable with using it because virtually every interview they go on, someone is asking, so how are you with AI? How comfortable are you with AI? How are you using AI? And even though the company itself maybe hasn't figured out how they're using AI, they want to have talent in the room that can actually help them do that, often is the case. So we're trying to find the best tools that we can bring into the classroom in an experiential space and say, okay, if we're doing a law review, if we're doing a case review, or a zoning review, how can you use AI to get you the information you need faster so that you can make the knowledgeable recommendation to your client, or you can make the knowledgeable recommendation to your boss about what you should do. If you're doing financial analysis, what's the best tool to do that? And how do you get the best information out of it? How do you build the prompts? How do you know, get the guidelines embedded in your interaction so it always looks at every bit of information it gives you through a certain lens? We've got to help them understand that, because that's how they will position themselves to be successful in their career paths. So can't ignore it. Can't, put the kibosh on it. Need to make sure that we're able to teach the fundamentals and then help our students understand how to use AI to build on that. We're still working it out. You know,
I know.
we don't do take home exams anymore. We don't do essays remotely. We don't. I mean, all those things where AI can be used to answer a test without controls. We've had to take those off the table so that we can actually help our students actually know they have to do the work.
It's kind of like the calculator. Remember?
Yeah,
Those
yeah,
better.
yeah.
I
Hey, show
know.
your work. No, I can't show my work because my calculator gave me the answer.
Right. That's the thing I can remember. Like, can you bring the calculator in this? Can I use a
Right,
calculator?
right.
So it just keeps happening, technology, and then teachers
Yeah.
and universities have to figure it out. Some people say that those exercises of actually doing the work, doing the calculation on your own, especially in commercial real estate, doing the underwriting on your own and knowing what the market numbers are, knowing the net migration, knowing okay, this is why this is class A and this is why this is class B, understanding the neighborhoods and,
Hmm.
all of that market research being
Hmm.
done by AI and not by a person, an analyst or an underwriter could actually make us make way more mistakes as you've mentioned before. And it could make us dumber because we're not
It could.
doing the math.
Right. Right. And I think that that's the whole thing. It's like, what can AI do for you that actually allows you to maybe have more time to do some of those other things, right? It makes you more efficient, but it shouldn't replace you. It shouldn't replace your knowledge. It shouldn't replace your on the ground experience because it doesn't have it. It doesn't have it. It can't tell me if I'm standing at the corner of Main and State Street, kind of what's really happening there in like real world time. You need those things. And we need to continue to promote the value of that as a part of the learning, as part of an experience that AI cannot bring into the decision process. And I think that's really important.
It is super important. Now, for someone starting out in real estate or any cyclical industry out there who's never lived through a downturn as you have, what's the one thing they should do now to prepare before they're forced to?
Find an opportunity to create relationships with people who have that experience who can help you understand what they mean. Going through a downturn by yourself has to be one of the loneliest and most honestly upsetting things you can do, right? It's just how do you man you need the benefit of people who've been through it. And I think that it's really important for people in the real estate industry to appreciate the value of network and industry community and connections and relationships that can help you understand the dynamics of tough markets, of financing challenges, of transactional problems. Those things come from experience. And while everybody needs to go through it, you don't need to go through it by yourself. There are just tons of folks out there who are more than happy to mentor, to guide, to advise, to counsel, and being open to that and recognizing that you will lose a lot of money if you don't engage with the expertise that's around you is probably the best way to prepare yourself to manage through a downturn. And honestly, in some respects, we're in one, right? When interest rates went up in 2022, you know, there was a real like oh no, what does this mean? Values change. Suddenly you were not underwriting something at a, 1% interest rate. You were underwriting it at a 4% interest rate. And that's a huge difference, And while office has struggled dramatically since COVID, we've had some other challenges. Multi-housing, overbuilding. Is that a downturn? That's a downturn. Overbuilding's a downturn. It may not look like it because you got cranes in the sky, but there's some issues with that. Or what's going on with the retail space? Post COVID, everybody was shopping online. Were people actually going to brick and mortar stores? We had stores closing. And I mean, we've had some real interesting, not great real estate cycle moments in the past 5 years. So if you're in this space, you see what some aspects of a downturn can look like, unless maybe you're an industrial. The industrial guys have been doing like crazy well. I mean, honestly, it's been kind of scary how well they've been doing.
Thank you for letting me
But
know.
but it's still, industrials had its moments in the past of being challenged. I mean, the GFC, industrial struggle, because all that industrial space had been used to support the home building industry, and the home building industry went down the tubes for a minute, right? So we've had all of these cycles. They all look a little different. They all may be driven by something slightly different than the one before, but maybe not the one 2 times before. People with that experience, people who have been through that, are incredible resources for people who haven't been through it. And the knowledge you can get from those relationships, being open to learning, will be a great way to prepare yourself and to also help you manage through it.
You're right. Mentors are phenomenal, and there's different types of mentors out there. That's not
Mhm.
always the guru. So
Oh,
I
right.
want
Yeah.
very clear that
Oh,
mentorship
yeah.
doesn't mean, guru, pay me $25,000.
Oh, no, 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 no. Actually, I'm trying to avoid those. I totally don't. That's not what we're looking for. We're not looking for that. We're looking for people who through industry, who you've met through industry. You're not paying them $50,000 for an hour of their time. I mean, that's not what we're doing. We're not doing that.
Right.
We don't need to do that. This industry has too many people with too much experience and too much, engagement to have to do it that way. And I
Absolutely.
think that oftentimes the gurus are not really the ones in the trenches either. So, I mean,
That is a
that
fact.
makes a
I know that
difference.
to be a fact. So
Yeah.
you've spent 9 years now building your reputation around leading this institute and shaping the next generation of socially
Mm.
conscious leaders in the industry.
Hope so.
What
I hope so.
Yes. So, what does that work prove about what you actually believe matters?
I think that, with the honest note that I walked into this industry without any idea what it did, who did it, why it existed, whatever. I knew nothing about this, right? And I've been fortunate to have seen it expand, grow. I mean, its impact, its scale is far off the charts of anything I ever could have imagined. But as part of that engagement, I also began to have a stronger sense or concern about how the built environment, which is everything we basically see when we look out a window. And I love having that conversation with high school students, kind of going, what do you know about real estate? And they're like, nothing. I'm like, well, then look out the window. It's like everything that you're looking at is actually part of this. So you can be a part of it in any number of fashions. But
Right.
understanding that the built environment has an impact on every human on this earth, one way or another, good and bad, willingly or unwillingly. It is the world. Recognizing that that is so important, I think it means that those of us who are in it have to have a sense of concern about how we engage with the world. And that if we're engaging with the world through the built environment, we should be honest and aware of the good and the bad. So, in a school like Roosevelt, which was founded in social justice, the idea of making sure that the students who come through our program have a sense of how they can be a socially aware participant in the built environment, I think is really important. We need to understand the impact of disinvestment in communities. We need to understand the impact of building a data center in the middle of a cornfield and it using excessive amounts of water that are impacting the other people who had nothing to do with it. We need to understand environmental justice and how the projects that we build in some places or a public policy that allows certain types of uses to be in spaces can negatively impact the lives of the people who live around it. We need to understand the importance of housing affordability to build an equitable and socially equitable world. All those things, but all those things tie back to real estate. They all tie back to the built environment. And I think it's important for me personally to talk about that. But I also think it's important for us as a real estate program, especially in a city like Chicago, to make sure that our students have that sensibility and that they approach what they do in this industry with a consciousness of the impact that it will have on the people around it. And, it's not like we're standing on a soapbox preaching this every day. It's something that you integrate in just the ethos of how you talk about things and how you help students envision what that project could do for a community, plus and minus. How bad is gentrification? How can gentrification be a good thing? How can it be managed in a way that it does not displace? There are lots of things that we do that we can always do better. And I want to make sure that our students see that. And I think that that is a really important outcome of the educational process that we put our students through.
When we first met, that is really exciting, and I think people should check out that program. I'm not sure if they have a similar program in different states, but what's the average age of that program at Roosevelt? Is it like
Well,
just the get
we have
door?
undergrads. No, we have undergrads and we have grad students. So, our
Uh,
undergrads are, your typical undergraduate world, somewhere between 18 and 25, you know?
right.
Actually,
Hmm.
I had a conversation with someone yesterday. I think we need to recognize that undergraduate students are getting older. They're
Ah,
they're not all 17-year-old freshmen because people
interesting.
come at higher ed, at least in our environment, at the community
Hmm.
that Roosevelt attracts from a student perspective.
Hmm.
Not everybody can go to college directly out of high school. And
Right.
so you wind up with people having, detours. They went to the military, they went to the armed services, or their families weren't in the position to fund it, or whatever it was, and they come back to school later. So our undergrads can be as old as 25 or 26 years old. And then I can have grad students who could be 22. I mean, depending upon where they come at. So, and also, a lot of people find the real estate industry later in their lives, right? Because it's not obvious. And it's not obvious how you get there. It's not obvious how you
Right.
want what you do, but people
Mhm.
learn about it and then they come back to grad school. And so we may have grad students who are 40. So it's a pretty broad range.
Right, right. When we first met, you gave me a phenomenal list of different institutional investors
Mhm.
and community partners that will support certain neighborhoods being developed. Is that still something that's happening? Could you talk a little bit to that? Some of those corporations that have certain funding to develop certain communities.
Well, I think that you would find in most cities, there are organizations, many of which are not for profits. They can be significantly sized not for profits, who have a mission to develop in certain communities and help lead the redevelopment of communities or help with housing development in communities. That is a very common thing. And also with the continuation and expansion of the low income housing tax credit, there's going to be additional capital that some firms can access to do that and, put that money into rebuilding the housing in some communities. You also have the opportunity zone business model that there are firms that are squarely into investing in opportunity zones in different cities. And those are tools that are used to help redevelop or additional development in communities that have not necessarily always seen the sort of capital flows in the recent years that they need in order to continue to be vibrant and viable communities for our citizens. So there are a lot of firms that are still doing that. Corporations, it's like, what is their motivation for doing that? Banks have CRA credits, and banks are going to continue to have to explore investing those. And platforms that can help them do that will be pretty active, I would imagine, for the foreseeable future. I'm not sure about just your general private corporation. Some of them are, that's kind of what they do on the side. Some of them have like market rate housing and affordable housing platforms that go side by side. You can see them do that. But I think we'll find that most of the ongoing community redevelopment or expanded development initiatives are going to come out of the not-for-profit space and like CDFIs and some of the, state funded kind of agencies.
Awesome, awesome. I remember on that list, Chase was one of the
Mhm.
companies on that list, for
They did.
instance. And
Yeah.
they had a very specific department that had you not given me that list, I would have never known anything about how to it's not public information. So, Colette, I was thinking we can offer maybe I'll offer an updated list in the show notes of
Mhm.
organizations that are supporting affordable housing and supporting new developers going into that space, which is something that I was very blessed to get from you. And I'd be happy to share that updated list. I guess I'll use AI to find the latest.
You might have yeah, I mean, I think that's a good idea. I mean, but I do want to just kind of caution folks that, there are some programs that are very much focused on supporting new developers in the affordable housing space. I caution that. I think it's a great intent. I think the outcomes are challenging. And I think that it is really important for us to be honest about
And
how difficult it is to be a housing developer, especially in
right.
the affordable housing space. It seems like it's a great entry point and people are trying to get, people through programs to prepare for that. And some people are ready for it, but it's
Mhm.
a long slog and it takes a lot of patience. It takes a lot of backdoor capital so that you can manage to hang in there till it's done. And it's very hard to scale a business. So I would encourage people who want to be in that affordable housing space to think about housing affordability through a lens other than just low income tax credit housing and
Mm.
find ways that they can maybe execute an affordable lowercase a housing strategy that would be a shorter term and get you to the end game faster than many LIHTC deals will. Not to say LIHTC doesn't have a space. It's a capital structure that people love, but it's not as easy a space to execute in as I think sometimes it appears to be.
Awesome. Well, this show is called Change and Triumph, looking back at everything you've survived, everything you've learned, and everything you're building right now. What has been the
Thanks.
greatest change and what has been your greatest triumph?
My greatest change, I would have to say, honestly, the greatest change I've seen in at least my career is my change from going from the private industry into academia. That's about as 180-degree change as I could actually imagine, notwithstanding all the other cycles I've been through in the industry or whatever. This shift out of the day to day, on the line transactions and industry investment strategy to being somewhat outside of that, but hoping to bring in new talent, to prepare new talent to be successful in this new world that keeps evolving on us has been my biggest change. I like to think that as I look back on my career at some point when I eventually decide to stop working, which, oh my goodness, when will that be? Is to look back on this and go, the thing I will probably be most proud of is what I will see my students do in the real world. The students who come through this program. Being a transactions wonk and say, you've done $10 billion worth of transactions and you've been, you've done market, we're a capitalist industry. That's everybody, a lot of people have that story. Having a little bit of a story that says that I've been able to have a positive influence on the long-term scope of this industry by bringing new talent in the door that is socially aware, that is knowledgeable, that is excited about being a part of the space and is looking to make a difference. To me, you know, that's kind of the outcome I think would be my greatest accomplishment.
It has been an absolute honor having you
It's
on
been a
this
blast
show.
today. Thank you. Thank you for
Thank
asking
you
me.
so much.